Every time the stock market hits a record high, you hear the same phrase. Stocks have never been more valuable. But here's a question almost nobody asks. What if the market isn't going up? What if the dollar is just going down? Because a stock index is measured in dollars. And if there are more dollars in the world, the number can rise even when nothing has actually become more valuable. So which is it? Are record highs real, or are we just measuring with a shrinking ruler? To answer that, you need to understand the money supply. The money supply is exactly what it sounds like. It's the total amount of money circulating in an economy. And it's not a fixed number. It grows. Sometimes slowly, sometimes very fast. The key insight is this. A stock index is a number of dollars. The money supply is the number of dollars in existence. If the second one grows, the first one can grow with it, without any company actually earning more or being worth more. That's the denominator effect. You're not measuring a bigger thing. You're measuring with a smaller unit. So how do we actually measure the money supply? Economists use a few definitions, and they go by the labels M1, M2, and M3. M1 is the narrowest. It's the most liquid money. Physical cash and the money in your checking account. Stuff you can spend right now. M2 is broader. It's M1 plus savings accounts, small time deposits, and retail money market funds. Basically, money that's either spendable now or can become spendable very easily. M3 was even broader, but the Federal Reserve stopped publishing it back in 2006, so you can mostly ignore it. When you see a headline about the money supply, it's almost always talking about M2. That's the standard. So M2 is the one to know. Here's where it gets interesting, and here's where most takes on this go wrong. Knowing that the money supply grows isn't enough. You have to know how fast. And that rate changes dramatically depending on what the Federal Reserve and the government are doing. During the pandemic, M2 grew at over 26% in a single year. That is an enormous, historically unusual expansion. When the money supply grows that fast, a big chunk of any market gain really is just the denominator. The ruler really was shrinking fast. But that is not always the situation. As of this video, M2 is around $22 trillion, and it's growing at roughly 4 to 5% per year. That's modest. It's close to the historical norm. And here's the critical point. A money supply growing at 4% cannot explain a stock market that's up 20 or 30%. The math doesn't work. So when the market hits records during a period of normal money supply growth, most of that gain is not the denominator. It's something else. Earnings, productivity, or simply investors willing to pay more for the same thing. So this is the tool. When you see a record high, don't just accept it, and don't just dismiss it. Ask one question. How fast is the money supply growing right now? If it's growing slowly, the record is mostly real, driven by actual earnings and sentiment. If it's growing fast, a meaningful share of that record is just monetary expansion, and you should mentally discount it. The honest answer is that almost every record high is a mix of both. Your job isn't to pick a side. It's to know the ratio. Which brings us back to today. The Dow recently closed above 50,000 for the first time ever. Is that real? Well, the money supply is growing at a normal pace right now, so most of that milestone is not the denominator. But the long-run picture is different. Stretch the timeline out over decades, and a real portion of every long-term market gain is monetary expansion. Both things are true. The short-run record can be mostly real, while the long-run trend is partly an illusion. The money supply is what lets you tell the difference. That's the money supply. We cover the markets on the days that actually move, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.